All right, welcome back to my YouTube channel. My name is Caleb. Welcome to my page, Study with Clef. So today we'll be starting our first class, basically just as an introduction to everything related to accounting, especially for those that have not done this before. People with exemption from ICAN student, professional level, skills level, foundation, and the likes of such. So here, today we'll start with IAS 1. IS1 covers basically all that you need to know, although there are still larger extents that you need to go anyways. But IS1 talks about more things or the basic fundamental things that you should be able to do as an accountant and as somebody aspiring to qualify as a chartered accountant or any other professional qualification that you are trying to get. So IS1 is presentation of financial statements. I've had many people ask, like, what do we even do basically as an accountant? And then you might be wondering what you do or what you are expected to do. So you need to know this background knowledge, have a complete understanding of how everything works. So today, presentation of financial statements, where you talk about the assets, the liabilities, income, expenses, and other things. So here we'll differentiate each of them and see what they comprise of or what are listed under each of them. Because I've also had people mistake things for each other. Some people don't know what is to be part of a non-current asset, what should be part of a current asset, what should be part of non-current liabilities and the likes of such. So today we'll break everything down to the barest minimum so that we all can understand. So we'll talk about the definition, of course, which is very straightforward because it's just AS1 basically. Talk about their recognition, talk about the components of financial statement. So I'll just abbreviate this for quick, but because of time basically. So components, we also have elements, elements of financial statements. So when we do all of this, when we break them down into simpler particles or smaller particles, then we'll talk about how they go. So basically, IS1 sets out the framework by which financial statements are to be presented. So especially for quoted companies are companies whose shares are listed on the public market. So So for quoted companies who are to publish their financial statements, this still relates to all of that. So we'll just do them gradually. So IS1 sets out the framework by which financial statements are to be presented in the public market or as deemed fit by some organization. So the definition has very little thing, basically. So the recognition is on each of these components. So at first, before we can know these recognitions, we should be able to identify the components of financial statements and also the elements of financial statements. So coming to the components first, we've been talking about financial statements generally since morning. So what are financial statements now? So we need to know what financial statements comprise of or what it contains. So the components of financial statements. So some of us already know this. but some are still new, which is why I said this is a general class. Statements of profit or loss and other comprehensive income. We talk about those things that are under these things, each of them. So our statements of financial position. Uh, Statements of changes in equity. And statements of cash flows. And then the last one, which is the notes to the account. So basically, these are all that should be presented for companies, most especially public companies or quoted companies. So these three are called published accounts, while this, the statement of cash flow, relies on these three, meaning that you need to understand each of them very well before you can do your statement of cash flows. Before you can prepare your statement of cash flows, you need to understand each of these items. Then notes to the account are just additional notes which should be included in your report, basically, just to aid understanding for the users of financial statement. So let's start with the statement of profit or loss. Statement of profit or loss are also called income statements, which includes your revenue, your costs, so your expenses, your profit for the year, gross profit, net profit, and the likes of such. So statement of profit or loss only relates to an accounting year. It is not a carry forward something. So it relates to just an accounting year. Statement of profit or loss carries for the year ended. Meaning that it is only for a year. So because some people also mistake, should this be as at the year end or should it be for the year end? So which is why we're making this video together so that we can understand better. So this is for the year end. It is just for an accounting year. But statement of financial position shows the current state of a company at a particular time. So meaning that I can say this is my net worth as at 2018. As at 2019, it may increase, meaning that it is carrying part of 2018 in 2019. So this is a carried forward item. It continues. So your balances continue from year to year. So this carries as at the year end. So this is as at a particular point. This is for an accounting period, while this carries both past period till current period. So as at now, what is the current state of the company? So we get to know that from statement of financial position. Then statement of changes in equity relates to statement of financial position. Just that statement of changes in equity shows the breakdown of the equity elements. We'll still define all of these things one by one in the elements of financial statement. So statement of changes in equity shows the breakdown of the equity elements of the statement of financial position. So it is also for the year ended. for a particular period. Then statement of cash flows. This shows the cash position of a company, like how much cash do we have, how much cash have we spent, how much cash did we actually use. So it does not really relate to how much have we realized, like how much did we actually get cash, what we actually have in hand. So just like the name, statement of cash flows shows the cash position of a company, how much you spent, actual cash that you spent, and the actual cash that you received. So that's statement of cash flows. It is also for the year ended. For the year. The notes to the accounts, like I said, are just additional notes that aid understanding for the users of financial statements. So this relates to all of them. Notes to the accounts relates to all of the components of financial statements. Some of them may be financial and some of them may not be financial. Some are just disclosures, things that you expect that your users of financial statements should know. That's notes to the account. Then it's just additional notes, like I've said. So we can move further now. Now we know what the financial statement comprises of. And we can proceed to the elements of financial statement. This is where we talk about each item that is under each of these components. So the elements now. All right, so the elements of financial statements now. We have assets. I know so many of us have heard about assets before. We have liabilities. We have income. We have expenses. And then we have equities. So like I said, the class is a foundation class which we actually need, all of us, because we, like I said, some don't know when to classify something as assets and when to classify some as liabilities, or when to take them as expenses and likes, which is the purpose of this. So assets, as defined by IAS 16, we'll still come to that. This relates to basically all standards, which is why I cannot just jump into standard. So we need to understand each of these things. So assets as defined by IAS 16, they are resources controlled by an entity as a result of past events through which future economic benefits are expected to flow into the entity. So it means that for you to say you have an asset, I know general knowledge of assets, say, okay, I have this thing, I have this thing, but if you don't have control over that thing, it means that you cannot actually classify it as an asset. So when we get to IAS 16, we'll define this better, the recognition, presentation, measurement, and the likes. So liabilities, on the other hand, they are obligations, present obligations, as a result of past events through which future economic benefits are expected to flow out of the entity. So this is an obligation, which this is a resources. You control this as a benefit to you. This is an outflow of cash. This results into an inflow of cash. Then income, on the other hand, they are economic benefits also, which are generated by companies. Then expenses, they are also similar to liabilities, which are obligations, an outflow of cash, which you are to settle at a particular period. Then equity are residual interests, which gives an owner the right to control an item, basically. So you have a residual interest in a company as an equity holder. So coming to each of this now, assets. Assets are we have this under statement of financial position. So I'll just short it, just like I've written before. So this is statement of financial position. We can also find liabilities in the statement of financial position, while income relates to statement of profit or loss and other comprehensive income. Expenses also statement of profit or loss and other comprehensive income. Then equities are found in the statement of financial position. So just like we have this component of financial statement, these elements of financial statement are those things that are found in the components of financial statement. Like I said, that those components of financial statement are those things or the items which are to be presented in the financial statement of a particular company. So this basically assets has a debit entry. I'm using this class to lay general foundation because of when we start uh, properly. We've actually started properly, but when we get into the business per se, so that we can flow together. So liabilities have credit entries. Income, they have credit entries. Expenses, they have debit entries. While equity have credit entries. So assets, we said assets are resources control. So if we say that asset has a debit entry, it means that if I'm saying that I'm debiting assets, it means that I'm adding to it. If I am crediting it on the other hand, it means that I'm deducting from it. For liability, it has a credit entry. If I am to credit liability, it means that I'm adding to it. If I am debiting it, it means that I'm deducting from it. Income have a credit entry. Adding to it means that I'm crediting it. While if I say that I'm debiting it, then it means I'm deducting from it. Same for expenses. It has a debit entry. If I debit expenses, it means I'm adding to expenses. So if I should say that I'm crediting expenses, it means that I'm deducting from it. Then lastly, equity, they have a credit entries. So if I credit equity, it means I'm adding to equity. And if I debit equity, it means that I'm deducting from equities. So because of subsequent classes where we'll start passing entries. So for assets, now coming to the breakdown of each of these things. Assets. Assets are divided into two basically. We have one as the non-current assets. And secondly, we have the current assets. So non-current assets, both of them, both non-current assets and current assets are assets. But what makes one to be a non-current asset and what makes one to be a current asset? Like I've said, this has been a problem for some people. So non-current assets are those, like we've defined assets before, as resource controlled by an entity in which future economic benefits are expected to flow to the entity. So assets that can be held for over an accounting period. An accounting period is 12 months. So if you can control these assets for more than 12 months, then it should be classified as a non-current asset. Then for current assets, these are assets which can be realized, like you can generate complete cash from them within an accounting period. So if you can generate complete cash of an asset of an item within 12 months, then it means it should be classified under current asset. So we have examples of this for non-current assets now. We have so many, but we just list some just to demonstrate this thing. We have plant and machinery. This is governed by IAS 16. Like I said, we'll go into all of these standards generally, but we need to understand the foundation so that we can flow easily together. We have furniture and fittings. We have motor vehicles. We have leased assets. We have bearers plants. We'll talk about this thing properly when we get to their standards, since each of them have their specific standard. Like this three, IAS 16 is not limited to these three, but just an example. Because when we get there, we'll show them properly. IAS 16. Leased assets or rights of use assets. This is governed by IFRS 16. While this is under IAS 41, which is accounting for agriculture. Then we have some other ones. We still have investment properties, which is still under non-current assets. So like I have said, as long as you can hold these assets to generate future economic benefits over an accounting period for more than 12 months, then it should be classified as a non-current asset. If any of these, for example, can be realized completely within an accounting period, regardless of the fact that I named them under non-current asset, they should be part of current assets. So we'll see what are also under current assets now. I think yes, demarcate this. So here we have inventories. This is IAS 2. Have receivables. Receivables does not really have a particular standard. They have cash, bank, they're all together. It can be separated too, basically. So cash, bank, cash and cash equivalents. We have deferred tax assets. Don't worry, we'll do justice to all of these things. This is under IAS 12. We also have assets held for sale. Which is under IFRS 5. And okay, and every other one. It is not limited to this. We can also have prepayments, and the likes. So these are examples of things under current assets. So like I said, these are items that can be generated or which cash can be realized from within an accounting period, that's 12 months. So if any of them cannot be realized within 12 months, then it should not be considered as an item of current assets, rather a non-current asset, as long as it's a resource control, just like the definition of assets. So here, this asset held for sale has a standard, but I just want to lay emphasis on something. Each of these assets here can still be classified as current assets, just like I have said, as long as we can realize the cash from them within an accounting period, which is why we have this standard. That's asset held for sale. So you may be seeing plants in current assets in some questions, and then you say maybe they are wrong. So you should just check well. It's either it's an asset held for sale, meaning that they are planning to sell that asset. It can no longer generate future economic benefits for over 12 months. That's over an accounting period. So that's for assets, non-current assets, and current assets. So the second one is liabilities. Liabilities. So liabilities also, just like we have assets, we have liabilities. I explained that liabilities are present obligation as a result of past events in which future economic benefits are expected to flow out of. This is asset is coming into the entity, while liability is an outflow of economic benefits. So non-current liabilities. And secondly, current liabilities. So just like an asset, it is still similar to liabilities. Non-current liabilities, it means that these obligations are not due in the next 12 months. That's within an accounting period. If they are to be settled later in the future, that's more than 12 months, then they should be classified as non-current liability. That is why you will see the same item under non-current liability. You'll still see that same item under current liability. An example of it is loan. You can see loan under non-current liability, and you can still see loan under current liability. Depends on their lifespan. So what differentiates these two is the lifespan, which is either it's more than an accounting period or it's within an accounting period. So non-current liabilities, they are obligations which you are expected to settle, not presently, not within an accounting period, that's not within 12 months, but later, maybe after 1 year, after 2 years, later in the future. While current liabilities, on the other hand, are present obligations which must be settled within an accounting period, which is 12 months. So an example or examples of this non-current liability. So this we have long-term loan, which is why I added long-term. Maybe a 3-year loan, a 4-year loan, long-term loan. Can also have debentures. You can have bonds. All of these are, as long as they are not to be settled within an accounting period, then they are all under non-current liabilities. Then current liabilities, on the other hand, like I said, it may still consist this thing, although there are peculiar things that are under current liabilities. All right. So for the current liabilities, they said there are obligations which are to be settled within an accounting period. So we can still have loan, like I have said, short-term loan now, just like that was long-term loan, that of non-current liability. For current liability, we'll have short-term loan, short-term loan. Then there are some peculiar things under current liabilities, which are expected to be settled within an accounting period. An example of them is trade and other payables. We have income tax liability or income tax payable. Then bank overdraft, and the likes of such. So we now understand what differentiates non-current assets from current assets, non-current liabilities, and current liabilities. The lifespan differentiates what should belong under non-current and under current. So that's for assets and liabilities. All right. So now to equity items. Equities. Like I said, equities are like investment, which gives the owners residual interest. So equity items, that's where you have ordinary share capital, ordinary share capital, you have share premium, you have retained earnings, you have revaluation reserves, valuation. Then you have general reserves, you can also have foreign exchange reserves. So this particular one has a particular standard which is governed by IAS 21, that's foreign exchange. So these are also examples of equity items. Like I have said, we may be finding it difficult to understand where to actually classify each item. So we've seen that of assets, liabilities, and equities. So we can proceed further to income. So income, like I said, there are cash benefits to an entity. So income is basically divided into two, which we have the revenue and we have other income. So both of them are income, but revenue are those income generated from the sole operation of the business. Let me write it in full. For example, now, if I am into manufacturing of cars, so if I sell car, the sales of car becomes a revenue to me because of my operation, since I'm into the manufacturing of cars. So if I should sell any of my cars, it becomes a revenue because of the operation that I'm into. That's the nature of the business. So income generated from the sole operation of the business is classified as revenue, while other income generated from other areas, like for example now, a company that is manufacturing cars now sold one of its used land, just for an example. So he sold one of its land. That land, the income generated from the sales of land, will not be recorded or regarded as revenue, but to be regarded as other income, because the nature of the business is into manufacturing and sales of cars. So any other income apart from the nature of the business are classified as other income. So while revenue are income generated from the sole operation of the business, other income are other income, just like the name, other income generated from other areas in the company. So I think that explains itself like that. So the last one, which is expenses. Expenses, just like I said, they are outflow of cash, basically. Just like income gives you rights to receive economic benefit, expenses gives you an obligation to settle some expenses, to settle some obligations. So expenses under published accounts, like I've said, can be classified under several heads, but some of the major ones, we have the admin expenses, that's administrative expenses, have the distribution costs, we have finance costs. So these, it's not limited to these three, but these are the major ones. When we get to published account on its own, like I said, published account includes your statement of profit or loss and other comprehensive income, statement of financial position, and statement of changes in equity. Statement of cash flow is a separate thing on its own, which relies on your published account. So admin expenses, just as an head, it includes expenses that are basically for operation of the business. So like company salaries. So examples of expenses that are classified under admin expenses are like salaries, rents, um, overheads, and the likes of such. Especially fixed items like fixed costs, something that you're expected to do every year. Just like salaries now, you're expected to pay salaries as a company, as an entity. Your rent also, then your fixed overhead, things that you are expected to do. While distribution costs relates to revenue, they are those expenses that are related directly to generating revenue. So, for example, your bad debt, your bad debts are related to revenue. So when you sell goods on credit, we're still coming to accruals and cash and accrual basis, just like the basis of accounting. So we have distribution costs. We say there are those expenses relating to the generation of your revenue. While finance costs, they are costs relating to financing, just like the name, financing the entity. So, like you had to borrow loan just for you to continue operation. You had to venture into the venture. You have to buy stock. Those interests that you pay on these finances are classified under finance costs. So finance costs are basically uh, items that include interests. So you have things like interest on loan, interest on debentures, and the likes of such. So in some cases, you will see it as interest expenses. It is still the same as finance cost. So with this, we have been able to show each of the elements of financial statements. That's the assets, liabilities, income, expenses, and equities. So let me quickly talk about the basis of accounting. So here we have the cash basis, we have the accrual, and we have the breakup basis. So cash basis, just like the name, once you understand each of these items, then it becomes easier. Cash basis relates to cash items, like you recognize revenue when you receive cash, and you also recognize expenses or expenditure when you pay cash. So you will not recognize an expenses when you've not paid for that expenses, but you will also not recognize a revenue when you have not received the cash element of that revenue. So meaning that if you cannot sell on credit under cash basis and record revenue, so basically financial statements, that's the published account, income statement, statement of financial position, and statement of changes in equity are basically prepared using the accrual basis. I've not explained accrual basis, but they are prepared using the accrual basis, while cash flow is prepared using cash basis. That is what differentiates some of them. They still relate together. So accrual basis, on the other hand, records revenue when you have earned it, meaning that revenue or income are recognized when earned and not when paid for. So I can sell to somebody on credit and I say, okay, yes, I will be expecting certain amount from this person because I have transferred the ownership of that item to the person. So I have already concluded or completed the obligation which I'm expected to do. So revenue on its own has a standard which we will deal with when the time comes. So accrual basis recognizes revenue when earned and not when cash is paid, and also recognize expenditures when incurred and not when you actually pay for them. So you can recognize expenditure even when you have not paid for it. So meaning that I can buy something on credit as long as I have that item in my custody and I have all the rights to enjoy benefits of that item, then I can recognize expenditure even when I have not paid for it. So that is what differentiates cash basis and accrual basis. Cash basis recognizes revenue when you have received the cash and also recognizes expenditure when you have actually paid the cash, while accrual recognizes revenue or income when you have received or when you have earned it rather. So when income or revenue is earned, meaning that I I sold something to somebody even though I have not received the cash, but as long as I have transferred the ownership of that item to the person together with the right to control that item, then I can recognize revenue, and also recognizes expenditure when incurred and not when cash is paid. So that's the differences between the cash basis and accrual basis. And like I said earlier, the all published accounts, that's the statement of profit or loss, statement of financial position, and statement of changes in equity, they work under accrual basis. They are prepared using accrual basis, except for a certain time, which is this last one, known as the breakup basis. So companies that are going into liquidation, like they can no longer function as a company in the nearest future, they are prepared using breakup basis, meaning that you sell all of your assets and all of your liabilities just to see how much you can actually receive rather for from all of your assets. So that's the basis of accounting. So we said cash basis, we prepare cash flow statements using a cash basis, then accrual basis, published accounts, which I wrote earlier, published accounts. So we will get to time that we'll actually prepare these things. Cash flow statement is governed by a standard on its own, while published account has so many standards in it. Then breakup basis, we can use it for published account also when you're actually liquidating your company, like you can no longer function as a going concern business. So that's that for the basis of accounting. All right, so so far we've been able to look at IAS 1. We've talked about the components of the financial statements, which are once again statement of financial position, statement of profit or loss and other comprehensive income, statement of changes in equity, statement of cash flows, and then the notes to the account, which I've explained earlier. We also talked about the elements of these financial statements, which are the assets, breaking them down into non-current and current, which we've listed the examples under each of them. The liabilities, also current and non-current, the equity items, the income, the expenses. So we've also talked about the basis of accounting, the cash basis, accrual basis, and breakup basis. So basically we have touched almost every part of what we need to do just as we are starting the class fully. So in subsequent videos, we'll talk about the actual standards. We'll go into standards now, starting from IAS 16. So that's under assets. So just follow me through so that you understand how these are done. So thank you very much for sticking with me all through to this time. And my name still remains Caleb. This is Study with Clef. Please, if this video has been of help to you, please like, comment, share to as many as possible people, your friends, people that really want to understand this thing. The purpose is just to understand so that we can grow together. So share to as many as possible people. Thank you. Subscribe also, and I'll see you in the next video. Thank you very much.